Hi, this is a video about the short-term rental loophole and other ways that you can deduct real estate losses from your regular non-passive income. So I'm just going to be showing you the tax forms because I feel like there is not a lot of videos that show you how these techniques actually look on your actual tax return. So we set up a sample here where we have someone who has $100,000 of W-2 income. And the only other thing that we have that we gave them here is they have this $5,000 of rental loss, which is appearing here on line 8. So if we go look at their Schedule E, so this is their Schedule E where they have $25,000 of rental income that they're receiving, but they also have these expenses, and they also have $15,000, so quite a bit of depreciation, and so that's resulting in a net loss. So this is not uncommon when you have a rental property where you may actually be able to cash flow with it, but because of the depreciation that you get to take from your taxes each year, it may show up on your tax return as a loss. So that loss may or may not actually benefit you in that tax year. You may not be able to deduct that loss from your income. So in this case, with their $100,000 of W-2 income, they are able to deduct that loss from their income, which means they end up with $95,000 as their adjusted gross income, which means that $5,000 of rental loss in this case is reducing their income and therefore reducing the amount of tax they have to pay. Okay, so what we've done now is we changed the amount of W-2 income to $200,000 instead of $100,000. And that's the only change that we've made. But if we scroll down here, line 8 no longer has that $5,000 of rental loss. So the rental losses that he got to deduct before when he had $100,000 of income no longer appears on his return. So let's take a look at why that is. So if we go to the Schedule E, so there's still that same $5,000 of loss, but it no longer appears here on line 22 where it did before. It also doesn't show up here on line 26 where it did before. This mentions form 8582, which is now showing up in his tax return. When he had the $100,000 of income, this form 8582 wasn't generated at all by the tax software because it wasn't necessary, because he didn't have passive activity losses that he couldn't deduct, but now he does. And so now there's this form. So let's take a look at form 8582. So form 8582 is the passive activity loss limitations form. So what this does is this calculates what passive income you can or can't use to deduct from your regular non-passive income. So this is limiting your passive activity losses. So their passive activity losses from that Schedule E are showing up here in Part 1. They have that $5,000 of loss. And then if we go down to Part 2, this is where it's limiting that loss. It's limiting the amount of loss that they can subtract from their non-passive income. So what we see here is the $200,000, which is their W-2 income. It's their regular non-passive income. And it's comparing it to this fixed amount, which is $150,000. So what that is it's calculating whether or not they can qualify for what's called the $25,000 passive loss allowance. So if your income is below $150,000 for the year, you can take up to $25,000 of rental loss against your income and have that passive loss count to reduce the amount of taxes that you pay. So it actually starts phasing out at $100,000 of income. So if you have over $100,000 of income, between $100,000 and $150,000, it phases out until at $150,000 of income, you can no longer deduct any passive losses against your regular income. So one other thing I want to mention is that when you have this rental loss that you're not able to deduct from your regular income, it doesn't just get lost. So when it's on the 8582 form, it flows down to section 7 and 8. This gets carried forward to future tax, your future tax returns. And so it gets carried forward indefinitely until you can use it to offset future passive income. Okay, so the only change I've made now is I have made it so that the Schedule E rental income is now considered non-passive. So this is the change that you make if you're going to take advantage of and use what we call the short-term rental loophole. So in this video, I'm not going to go into all the specifics about how you qualify for it, but basically the way that works is if you have a short-term rental and also if you materially participate in it, if you are active in managing it, then you can qualify for this loophole, as it's called, which is basically a way to make your rental activities non-passive. And when you use that technique to make your rental income non-passive, then once it's no longer passive income, then the losses from that activity can count against your regular income and reduce your taxes for the year. So let's take a look at what that looks like on the tax forms. So the way you make this change in your software depends on what software you're using. Most tax software will have a way where you can say this Schedule E rental activity is now non-passive. There might be a checkbox for it or a way to make that change. I believe in TurboTax, if you go to Forms mode, I think there's a checkbox somewhere in the forms where you can make that rental activity non-passive to make this change. So now that we've made that change, if we look at the Schedule E, so we now once again see that the line 22 now has that loss again listed here, and that flows down to line 26 at the bottom here. And what that means is that loss can now be once again deducted from your regular non-passive income. Also, the form 8582 is no longer here because we no longer have any passive income, so it's no longer included by the software on the tax return. If we go back to the 1040 form, we can see that we have the $200,000 of income, and then once again, we have here the $5,000 of rental loss that is subtracting from that income, and therefore that $5,000 of rental loss is now reducing the taxable income, and therefore it's reducing the amount of tax that we have to pay. So those are a couple of ways that you can use rental losses to reduce your taxable income on your tax return.